I'm Clifford Hoyt, a licensed pharmacist with a PhD in nuclear pharmacology and a former New York State Board of Pharmacy president. I founded my company, Home Care Management, in 1986. Selling medical supplies and equipment to the public, our growth was exponential, and we went public in the 1990s with a new name, Health Management Incorporated. Our principal line of business was chronic disease management. We specialized in expensive drugs needed for a wide variety of serious chronic illnesses. After our previous audit firm resigned due to concerns with our inventory auditing procedures, I hired BDO Seidman and met Drew Bergman. After resigning from BDO Seidman, Bergman was appointed as our CFO in 1990. In June 1995, Bergman informed me that we would not be meeting our analysts' expectations for the year. But I impressed upon him that not meeting target earnings was not acceptable under any circumstances. I was willing to commit fraud before admit defeat.
I, Drew Bergman, am the CFO of Health Management, Inc. I informed the CEO that the actual earnings figure for the fiscal year in 1995 would be approximately 54 cents per share. The CEO would not take the hit and wanted me to adjust the reports. I altered HMI's accounting records to allow HMI to reach its 1995 earnings target. My goal was to lower cost of sales and increase HMI's gross profit and net income. I inflated the company's year-end inventory by approximately $1.8 million. I also posted a few other small adjustments to HMI's accounting records. I was very familiar with BDO Seidman, our auditors, and their audit procedures since I worked there several years ago.
Bergman told me he would help me commit fraud if I found employees to help us. On my own, I found 7 employees to serve with us in our inventory fraud. To commit the fraud, Bergman increased our inventory by $1.8 million. $1.3 million claiming to be in transfer between Pittsburgh and New York City, and another $500,000 misplaced in New York's warehouse. We gave these 7 employees each a different but the same story to tell the auditors. We were getting away with the fraud, even though it was nearly 20% of our entire inventory as in transit. This was until Bergman was given a new title as Corporate Development Officer, and we had to appoint a new CFO. Paul Jerwitz was appointed as the new CFO, and while having a conversation with one of the co-conspirator employees, accidentally stumbled upon our fraud.
HMI stockholders filed suit against BDO Seidman for failing to detect the inventory fraud. During the trial, there was an anonymous letter that criticized certain HMI accounting procedures and questioned BDO's independence regarding a close friendship involving me and an undisclosed member of the audit engagement team. July 20th, 1995, I recommended that Maya Sai be offered the CAO position during an HMI board meeting. This meeting took place 1 week prior to the date of the audit report issued by BDO Seidman on HMI's financial statements. Under presently existing professional standards, this would violate Rule 101 of AICPA's Rules of Conduct. During the trial, the plaintiff's attorney used me as their principal witness to attack the credibility and professionalism of BDO Seidman auditors. However, my testimony worked against them since the outcome favored BDO Seidman.
In the end, I ended up with 14 counts of conspiracy and securities fraud, 9 years in federal prison, and had to pay a $250,000 fine and make $9.6 million restitution to the victims. The fraud was without a doubt my fault. However, Bergman could have easily prevented it. I wouldn't have been caught if I hadn't brought in the new CFO and information hadn't been leaked. Now, because of my behavior, future CEOs will be more closely watched in regards to independence with their board members and employees. However, I believe the audit firm is to blame as well. The audit firm proved to be too friendly as well. Perhaps if they had not been impaired by their friendship with Bergman, they would have been suspicious that 20% of our inventory was in transit. And there were several red flags besides this as suspicious behavior that they should have noted. And overall, they failed to do their due diligence. And as a result, there were fraudulent financial statements upon which many stockholders and investors relied upon.
Hi, I'm representing BDO in the HMI case. Our purpose is to provide reasonable assurance for HMI's financial statements. Our team was composed of Fred Bornstein, an audit partner, May I Tai, a manager, and Jill Karnick, a senior associate. Regarding the fraud, we believe that HMI's executive team is at fault because they're the ones that tried to defraud us as auditors and also the public. However, we could have done more to provide due professional care. We received a notice from the SEC regarding HMI's practices for allowance for doubtful accounts, and we did not perform any additional audit procedures regarding this account. Furthermore, we received an anonymous letter questioning our independence with HMI and saying that HMI was trying to mislead financial analysts. Jill Karnick was in charge of the inventory in transit and found an entry of $1.8 million at the end of the year, which was unusual because usually this account has a zero or negligible balance. Jill Karnick and Ty both spoke with HMI's management team but didn't do anything further to investigate this amount. If Karnick had done an inventory rollback, she would have noticed that this inventory is actually fraudulent and did not exist. Regarding the case and the new procedures in place by the U.S. government, we benefited from the fact that we were not responsible for HMI's damages and that we were only charged with our auditing and not the actual fraud. However, if we had performed some additional analytical procedures, we could have avoided this whole situation. First, we could have performed a reasonableness test of the overall financial statement and underlying documents. This would have shown the large inventory in transit and that it would warrant special attention. We would also examine the transactions relationship of inventory in transit to the inventory account as a whole with ratio analytical tests. We could have compared current inventory turnovers with historical ones, which would bring attention to the sudden increase in inventory in the inventory in transit category. Furthermore, we could have looked at trend analysis of the cost of goods sold account, which would test for completeness as well as valuation and allocation, and could indicate earnings management. Additionally, analytical tests relating to accounts that are directly affected by inventory and cost of goods sold, such as gross profit, would help identify the reasonableness of this relationship and show us that this is something else that we need to look into.